Buying a stock is purchasing ownership into a company. Options are simply contracts that are used to buy or sell a stock at a set price and a set time. So to reiterate, options are contracts. There are two options. There is a call contract and there is a put contract. A call contract is an assumption for the stock to rise and a bet to make money on the upside. A put contract is the opposite. It's an assumption that a stock will fall and a bet to make money on the downside. Now, here is laid out the 4 ways that you can use options. You can simply buy them and sell them. You don't need to own an option before you can sell them, and you don't need to sell an option before you can buy it. You can choose either one anytime. Now, if somebody's buying a call contract or a call option, which is the same thing, people use this to bet on the upside with leverage. Leverage is just extra risk exposure, meaning you can make a lot more money, but also lose a lot more money. And if you are buying a call contract or buying a put contract, you are paying a small premium fee up front, just like you're buying insurance. Everyone buys car insurance because if you get in a crash, you need the coverage. You can also purchase a call contract to be converted to 100 shares of stock at the strike price that you choose before expiration. For example, if a stock is $10 and you think it will rise, you could buy an $11 call option for next year expiration. If the stock rises, let's say, to $15, your call option will be worth a lot more money. You can then choose if you'd like to convert that call option into 100 shares of stock. That's called exercising. Or if you exercise the option contract into 100 shares of stock, you will have to purchase 100 shares of stock at $11 a share. Even though the stock is 15, you own it at 11. This is an advantage because it allows you to use the option as insurance. Does that make sense? So now with a put contract, it's the exact opposite of buying a call contract. People use this to bet on the downside with leverage. If you notice, all these top explanations are trading explanations, and the bottom explanations are more like investor insurance explanations. Those are the 2 ways that people use options. They don't use them any other way. So if you're purchasing a put contract, you're betting on the stock to fall. You'll make money on the downside. And this can also be converted to sell 100 shares of stock at the strike price you choose before expiration. Always let me reiterate, this is an if you want. You don't have to convert the shares. You can purchase the call contract or the put contract, make money on the way and the direction that you choose, and sell it to somebody else and make a difference of profit. This is how people trade options in the stock market. Now, this is what you can also do. You can sell the calls and the puts in the same way that you've purchased them. And like I said before, you don't need to have purchased a put or to have sold a put. You can straight up sell a put if you want. To do that, you'll have to put up 100 shares worth of capital as collateral, but I'll get into that. If you sell a call contract, people use this to make money as the contracts go down in value. So if you're selling a call contract, you're making money as the guy who bought the contract is losing money. So he loses money when the call loses value. You make money as that value is lost. You profit the difference. You can also use this to collect money by selling insurance. You can basically use your assets to collect rent for people who'd like to take the buy side. And in that way, you have to put up 100 shares of stock as collateral because you're collecting insurance. So you have to have some sort of collateral. Now, for the put side, you have to put up 100 shares worth of pure money, pure capital. Not 100 shares worth of stock. You have to put up 100 shares worth of money to sell a put option to collect insurance. Now, people use a put option. When they sell a put option, they're making money as the put option goes down. Let me reiterate as well. Options equal contracts. I hope you understand that. Now, I hope you can understand this section. This is the basics, and I'll move into the next section. Now that you understand what a call and a put is, I'm going to show you the example of how the option actually moves. So for example, let's say the call option price is $1. Remember, to sell options, you have to put up 100 shares of stock or 100 shares worth of capital. So this is going to be multiplied by 100 to get the cost of what you need to buy the option. So to buy this call option, you need $100. Pretty simple. So There's four factors that are going to move this option, and those are called the Greeks. I'm going to break down it very, very simple so you can see this and really just understand it. Delta is the contract's gain or loss per dollar move. The contracts cost $100 and the delta is $40. So that means if the stock goes up $1, this contract will be worth $140. And if the stock goes down $1, this contract will be worth $60. Now, that's delta. That's the main mover of an option. Second, you have gamma. Gamma is the addition to the delta per next dollar move. For example, the contract is $100, it goes up $1, so now it's worth $140, and then it goes up again. Well, then the delta is now worth 46 because this is added to this. And as it goes up again, this will once again be added to this. So every next dollar move, you can expect $6 to be added to delta. This is how the delta begins to compound from the gamma. Does that make sense? Hope it's simple. Now theta. Theta is how much value a contract loses per day. If this theta is $18, then this will lose $18 per day. The contract will be worth $84 after the end of the day if nothing happened except the decay. Vega is the contract's gain or loss per 1% change in implied volatility. If the Vega here is $20 and the IV is, let's say, 10%, that's what it is IV. That's what Vega measures. If the IV is 10% and the Vega is this, and then it moves and the IV moves to 11%, the contract will now be worth $120. And the same thing on the other side, if the Vega moves from 10% to 9%, the contract will lose $20. Now, all four of these are moving the price of the contract at the exact same time. It's not slow and it's not just one at a time. It's throughout the day, every second, super dynamic. Options are very volatile instruments. Now, I maybe should have given you this at the beginning of the video, but I'm going to give you a real life example of how an option is going to work. Let's say I am a butcher and a restaurant needs to buy their meat off of me for $10 a pound so they don't have fluctuation costs for their customers. So they come to me and they say, hey, I need to get the meat off of you for $10 a pound for at least like 1,000 pounds this whole year. I'm going to say, all right, that's doable, but you're going to have to pay me a fee. And I'm going to write this guy a contract and I'm going to price it in and I'm going to say, okay, take this contract. Now you can come to me and show me this contract anytime and I'll give you the meat for $10 a pound. But you're going to have to pay me $2,000 for this contract. He'll give me the $2,000 and now he has insurance that he can get the meat for a steady cost whenever he wants. If the price of meat drops, he can still go to the market and buy it. He doesn't actually have to buy the meat off of me for $10. But if the price of meat rises, then he's at a win because he now has insurance to get the meat for $10 and he's making more money because the meat's actually worth more than what I'm selling it to him as. So you see how this benefits both sides? It benefits both the seller and the buyer. That's an example of a real life call option. And I hope that you can take this and understand how we use this in stocks. If you like this or learned something, please subscribe and like. Thank you.